Hey, good morning, everyone. Marty Missouri here. Today is Friday, the 24th of February, 2023. Quick, I'll try to keep it quick. Stock market snapshot for you here. We're just going to look at the technicals. I'm going to give you a little narrative up front, as usual. We'll circle back. My plan is today with your economic update. I think that'll be the more important of the two presentations. This will serve as the morning note as well. A lot of you are interested in how the core positions are doing, so I'll just basically tell you that and then get on with today's monologue. So we only have one position of our 36 that is in the green this morning, and it's not a big position. It's MP Materials. It's up 4.5% on good earnings. Other than that, positions that are holding up pretty well, ironically, Dutch Brothers is only down 37 basis points. It was down a bunch yesterday on somewhat disappointing earnings, but it's up huge so far this year. That's a small position as well. Doesn't make a lot of cyclical sense, makes a lot of bottoms up sense, we think, and maybe something we add to if and when the market does as we expect during the course of this year, and that would be trade lower than it is now. Intermediate term treasuries, gold, financials, emerging market bonds, utilities, defense stocks, staple stocks, Mexico equities, AT&T. These are all down. Ag futures, oil services, just not down as much as the overall market. Things that are down more than the market, Amazon's down 3%, Albemarle, the lithium miner, is down 3%, Brazil's down 2.85%, Euro stocks are down 2.74%. So, yeah, very red day. Of course, our put hedges are up today. Those in this environment aren't consequential to the bottom line. Those are consequential, if we have a March 2020 event, a big sell-off, a market breaking to the bottom. And we think that risk is there, so that's why we keep those hedges on. They're not costing us a ton of money, but we're close enough to the money, so to speak, for them to be meaningful sooner than later if indeed we get something big in terms of the break. So this morning it's all about the hot PCE inflation number coming out. We flagged that in Wednesday's monologue. I said if you look at CPI and you look at PPI, it would make sense that PCE might come in hot, and that would be problematic for the market. And as I speak, the S&P is down 1.6%. NASDAQ, of course, is down more than that. So it's interesting to me, and it's somewhat ironic, because what the market appears to be freaking out over is really going to abate over the next few months, all things being equal, just because of base effects, because of what inflation was doing a year ago in, say, March, April, and May, and how the math is going to look, all things being equal, for, say, March, April, and May of this year. So the base effects are going to have inflation just coming off the boil a bit. The Fed, keeps screaming data dependent. I listened to a commentator on Bloomberg early this morning, and I couldn't agree more. It's just this data dependency makes for just intense volatility, just in Fed commentary, potential rate decisions, rhetoric, and that sort of thing. Very interesting that Chairman Powell mentioned disinflation 11 times during his press conference. And then the minutes, which are supposed to give us the conversation during that meeting, were completely void of the word disinflation. So makes you feel like the minutes may be somewhat of a communication tool as well. And meaning that, it would make sense that they are massaged given the data that came out, the 2 weeks since the meeting. It's unfortunate, but it kind of is what it is. And maybe it's not unfortunate. Maybe it's just one of their tools, because they do think inflation expectations, are key, I suppose. So, but at the end of the day, this adherence to a 2% target, we've said all along, and this commentator I mentioned reiterated that himself this morning and agrees, or we agree with him, or he agrees with us, however you want to put that, is that 2% target to get there, and they're so adamantly about not changing that. Two things. Does not reflect the world we live in. Now, the last 2-3 years, I've written volumes on populism, on what comes with that, which is a labor-friendly regime, and these things tend to go for decades, coming off of several decades of a capital-friendly regime, right? Whether you want to call it deglobalization, multipolarism, whatever it is, with this whole setup comes protectionism, right? I would call it deglobalization, but it doesn't mean we're deglobalized. We're still very globalized. It just means less so. And to the extent that we're less globalized, that's more of an inflationary backdrop, if you will. COVID was kind of the test, right? People were suffering, and the government didn't come in and, even give full unemployment, let's say, or extend it. They gave multiple times with $600 a week extra on top of regular unemployment benefits. They gave out, trillions in stimulus checks and gave a bunch of loans to companies, whether or not they were even suffering from COVID, these PPP loans that were non-taxable and forgivable. So unlike the 2008 scenario where a lot of people got crazy over commodities and we didn't, because yes, we had a lot of money printing, but we had a consumer that had to deleverage. This is different, right? This is a consumer who got into trouble and was given trillions, businesses that should have failed, private equity firms that should have gone belly up, hedge funds that were overloaded with just raunchy debt that we flagged back in 2019 as being potentially creating a worse credit crisis than 2008. All of that stuff got bailed out. But the consumer got bailed out as well in a big, big way, which really didn't happen in 2008. You add all that together, and two things happen. It does give you huge inflation right off the bat. You got the shutdowns, you got the supply chain disruptions, and then you got all this money hitting the market at the same time. So you got this huge bullwhip, right? Goods, we went through the whole bullwhip effect in the past, but you got all this goods buying, lack of ability to produce it, so it goes up like crazy. Now you got the manufacturing sector that's in a recession. They just are. But you have the services sector that's doing pretty well because people are now, spending. They got in that mode and they're still spending and they're still doing okay right now, and they still can. That's the next shoe to drop, of course, when this recession comes, that we do think it's a when, not an if, and it may come sooner than later. But at the end of the day, to get us to 2% sustainably, you're going to have to do a real number on the economy. The Fed is just going to have to, and we made this case, I'm sure it was at least 2 years ago, that ultimately, whether it's next year, the year after, what have you, and maybe they don't do it officially, they're going to have a different target. Structurally speaking, you're just not going to be able to do 2% inflation long term. You're going to do 3 to 5. You're going to do something like that. And now, if they had the courage to announce that, and they could do it and save face with just a new analysis of the world we live in, that would be very, very bullish when that happens, right? We are, despite what you're seeing, despite what we're feeling today, despite our near-term outlook, we are honestly exceedingly bullish if you have, say a 3, 5, certainly 10-year time horizon, because with this new regime comes a very rich macro investment environment. And we spent a lot of time on that, and we will going forward. And here I am taking a lot longer than I originally intended. So there's all that for what it's worth. I'll give you our economic update, I think, later today. I'm going to really try to get that done today because the weekend's going to be tough. So daily S&P 500 charts, pretty much playing out like the technicals suggested it should. Remember, we had our consolidation. I've done this enough here. I compared this one with that one. We had, bullish setup with our momentum indicators, and we broke out to the upside. Here we had a bearish setup, right? Broke down. I said we might come back and test that. We tried to, I think, on Thursday, and here we are today, gapping down. Again, not a good sign, obviously, near term. Whether or not this is what really, gains steam and takes us down to our 3,200 target, if that's where this thing's going amid a recession, that remains to be seen. I think that may come a little bit later than right here. Interesting today that we're getting this breakdown, but it's on really low volume. So that tells me that there's really no panic necessarily just yet. On the daily chart, remember we called this a reverse head and shoulders. There's your shoulder, there's your shoulder, or there's your shoulder, there's your head. And man, it looked good, right? This would be, this is where the shoulder, line meets the neck. So ironically, the neckline was the bear market trend line, right? Here's how this plays out. You break through the neckline. This was a very bullish pattern. You come back, you test the neckline maybe once or twice, and then if it's all good to go, you shoot higher, and off we go to the next bull market, right? I did say that's not how we think this is going to play out, and they're not low probability patterns. Head and shoulders aren't, but we for a lot of other reasons. I mean, this isn't the only thing we do here. We expected that this ultimately will be a failed pattern, right? Now, we're doing the test right here as we speak today. We're below the trend line as I speak at you today. And remember though, we had these bearish divergences right here, and we had the sell signal on the MACD, that's that yellow circle, and we had virtually an overbought RSI. And when we were here or close, we definitely were there then. What did we get? We got the market bottom so far, right? But that was the setup leading into that on these indicators. And here we are pretty much with that setup right here. So do we get a test of the 3,500? I think we very likely could get a test of 3,800. As I talk to you right now, the S&P is 39.44, pretty much on the lows of the day. But this chart is just a few minutes delayed. So nothing worse than a failed breakout, right? So we broke out, and right now we lost the 50-day. Remember, we talked about the importance short term of the 20-day, gave that one up, gave up the 50-day today. You give up the 200-day and the trend line, and I think you're just going to see 3,800. You'll get the top of this consolidation range, wherever that is, 3,900 or what have you. But there's some levels right here that make a lot of sense. And then you're going to see volume spike, right? Stop losses just below the 200-day moving average get triggered. You got a lot of put exposure down there. As that goes, those dealers who sold those puts have gamma working against them. And they got to hedge that, so they have to short the underlying. It gets to be kind of messy. Now remember though, that those shorts ultimately get bought, and they probably get bought at some of these support levels. So that'll be another conversation. So so there you have it. I dialed up the weekly and the monthly, but I'm going to run out of time. We're back. We're back in the downtrend line on the monthly. The monthly sell signal relative to the levels, which basically generated the 3,500 target outside of recession, which we hit and bounced off of. All of that's playing out, and it's beginning to deteriorate once again. We'll do that on another day. I've been doing the VIX for you here lately. You have just really classic technicals, right? Bullish falling wedge, broke out, retested it, jumping today. You had bullish divergences. Back when we were trying to figure out back over these past few weeks when I said, we could really move either way in the stock market, but then I went over here to the VIX. I said, the VIX says the stock market's going down. I wanted to also pull in the dollar. Our equity market conditions index, which we score once a month, we're in the negative. We're in bear market conditions. Two things that deteriorated were the dollar and geopolitics. Now, the dollar deteriorated because at the time we had, looks a lot like the VIX chart, we had a bullish falling wedge and we had bullish divergences. We are actually bearish long-term, the dollar, right? But right now, and the way stocks are trading, they are negatively correlated to the dollar, right? So here we got the breakout, we got momentum, we have momentum right here. The dollar is up 73 basis points today. That's a big deal. So this also pretty much comports with our near-term bearish look at the market. We could indeed, though, we could bounce right off of these levels. I mean, we could end the day flat or higher. I mean, we've seen that happen over and over again. Not how it's looking right now, but if I had $1 for every time I was wrong on an intraday basis, I'd have a lot of dollars. And then lastly, just volume. So this is the S&P 500 today compared to 5, 10, and 20-day average volume, right? So again, on a big panicky sell-off, this dotted line, right, should be up here at the top. We should have people just racing for the exits, right? So it feels like it today, right? But from a volume standpoint, it doesn't really say anything's broken. Doesn't mean we couldn't have more of a low volume sell-off. It just means this could get even uglier in a hurry. So that box, is yet to be checked, right? You can't really check that one right here. So folks, again, like I think I finished last presentation, we are bullish on a 5-6 year plus time horizon. We think the next 5-6 months are the definition of precarious. So clients, yes, we go down on down days, no doubt about it. We hedge so that we can't be devastated by some big sell-off, and we keep some powder dry. But again, the irony of it right now, and I'll close with this, is that here the market seems to be freaking out over inflation and trading lower on good data points like the jobs numbers and so on and so forth. When at the end of the day, we think that when we hit the lows, it's going to be as inflation is actually coming down, but the market's not going to be rallying because conditions are going to be such that earnings are falling through the floor. And that's where you get this big capitulation. And then down there, what do you get? Remember, this regime we're in means government steps in and protects people when they hurt, more so than they ever have, at least over the last few decades. And so that transpires, we think, when it gets really painful in the economy. And we get a Fed that'll be very, very accommodative in that scenario where the S&P is pushing down to those what we think are going to be recession lows. And that's going to be where we want to add risk to the portfolios. We're just not there yet, clearly. So, folks, thank you, as always, for watching and listening. Went way longer than I intended. I'm going to get right onto our macro update and then get out to you our up-to-date look at all things economic. Thank you again. Talk to you soon. Bye-bye.